Good morning, friends. Welcome to the point. The topic that we are going to discuss today is very important no matter whichever or whosoever exam you are preparing for, be it any state government exam or for the banks or for any entrance or for any college or institute. This topic holds very much significance as so many concepts revolves around it, and in order to understand the further economy videos you are expected to be really clear with these two concepts, because the more you are clear with this CRR and SLR understanding, more you will be able to solve the questions relating to inflation and liquidity control in the economy. So let us start with what CRR is. It is a reserve ratio that is required to be maintained by first commercial bank. Who asks commercial banks to maintain this ratio? It is RBI who tells them. Under which act? RBI Act 1934. Okay. Now the next question is, on which amount or as a percentage of what amount they have to maintain it? As a percentage of net demand and time liabilities. So there are two types of deposit accounts that the bank offers. First is the demand deposits and the other are time deposits. So the net of it, now this is discussed in another video, so you can refer for greater clarity as to what NDTL is, but as of now what you need to know is that CRR is maintained as a percentage of NDTL, that is net demand and time liabilities. Okay, now in which form or what form they have to maintain it? Is it the cash? Is it gold? Is it some foreign currency? No, it is just the cash or cash equivalents with RBI. Now the commercial banks do not have to maintain the cash reserves with them in the bank branch, but they have to maintain it with the RBI, which is the central bank of the country. It aims to ensure that the banks do not run out of cash to meet their depositors' payments demand. So why these reserve requirements are introduced or asked by the RBI? Because in case if future any bank has problem or paying the depositors or is about to get bankrupt, then in order to protect the interest of the depositors as well as the investors, they should have some cash money or cash to repay them back. So in order to maintain the interest of the depositors, such reserve ratios are maintained so that in case if any problem arises, they can pull out the money from these reserve ratios and pay it back to the depositor. So that is the main objective behind maintaining the reserve ratio, and there I have told you that they have to maintain it with themselves and not with the RBI. Now, what are the advantages of maintaining CRR? So the first one is it ensures the solvency position of the banks. Yes, obviously when the banks have sufficient liquidity with them or sufficient money with them, they will obviously not or never go bankrupt or insolvent. It will always help them in improving their solvency position. So hence this is the first advantage of maintaining CRR. The next, it helps in maintaining banks liquidity. Then third is, by this RBI controls the liquidity in the economy either by increasing or decreasing as the case may be. Now this I'll explain you via an example. So for example, we'll consider that there is 100 rupees deposit that is coming with the bank, okay, in a day or on some day. So do you think bank can lend out this whole money in the market as a loan? No, certainly not, because they have to maintain or keep out some money as a reserve. So now for example, if we take a standard ratio as or the prevailing ratio as 5%, okay, now if the RBI wants to increase the liquidity in the economy, so what it will do is, so first we'll solve this. So 100 rupees is coming, 5% has to be maintained, so 5 rupees got separated, and 95 is the amount that the bank can create or lend it as a loan. Now if the RBI wants to increase the liquidity, it will reduce this reserve ratio requirement, and let's say it makes it 3%. Now what? It is 100, the deposit is coming, out of which only 3 rupees has to be maintained. So what is left with the bank is 97 rupees, and this money can be used to create loans. So what you can see is, earlier where 95 was available with the banks to create loans, with the reserve ratio requirement reducing, the amount is increased in the hands of commercial banks. So whenever the RBI wants to increase the liquidity, they will reduce this reserve requirement. Now if RBI wants to suck out the liquidity from the economy, it will increase the reserve requirement, let's suppose to 7%. Now if 100 rupees is coming as deposit, so out of that 7% has to be maintained, that makes it 7 rupees, and 93 is left for the bank to create loans. So you can see the effect. Earlier it was 95. When the reserve bank want to increase the liquidity, it reduced it, so the money left with the bank is more. And when it wanted to suck out the liquidity, they will increase this requirement so that less loans are created in the market. So this is how it regulates the liquidity supply in the economy. Last is, it is faster way of implementing the monetary policy decision, as the other tools take time to trickle down their effect. Now what happens is, every 2 months RBI comes out with its bi-monthly monetary policy, in which it either changes the stance or keep it neutral. So in order to pass down the effect of monetary policy, these tools are used. The moment the CRR or SLR is changed, the commercial bank changes its reserve requirement over here, and whatever the final amount is, it can use to lend it in the market. So this is how RBI uses it to pass on the effect to the citizens. Next is, what is R? So it is a minimum deposit that the bank has to maintain with themselves. Now here comes the difference. As you have told you that CRR has to be maintained with the central bank, whereas SLR has to be maintained with themselves as a percentage of deposits in the form of cash, gold or other securities, and which are government securities like state government securities. The government uses SLR to regulate the inflation and fuel growth, like CRR and SLR is also decided by the RBI. So this is one of the common point, that both of the ratios of the are decided by RBI. Next is the way CRR is prescribed under RBI Act, SLR is given under Banking Regulation Act. So here lies the difference, and the CRR is to be maintained in just the cash and equivalents, whereas SLR can be maintained in cash, gold or other securities which are government securities. If the banks fails to maintain the required ratios, they are bound to pay penalty to the central bank, and the penalty would be the bank rate plus 3% on the amount which they are not able to maintain it. So for example, they are supposed to maintain 95 crores as the reserve ratio. If they are able to maintain just 93 crores, so they are falling short of 2 crores. So on this 2 crores, they are supposed to pay the penalty at the rate bank rate plus 3%. This is the rate of interest that the RBI charges to such banks. So this is about the SLR, and we'll go through the advantages of it. So yeah, one of the other things I want to tell you, my friends, is, so let's suppose 100 is coming as the deposits. Out of it, first CRR is removed, then SLR is removed out of this amount only, and not that first CRR is removed and whatever the amount is remaining, out of that SLR is pending. No, it is on this amount that CRR is removed and SLR is removed, and whatever amount is left is given in the market in the forms of loan. Now to the advantages. So first, it helps in ensuring the solvency of banks like the CRR does. Next is, it keeps a check on expansion of credit by the banks. Yes, how? RBI either increases or decreases depending on the economic situation. And last, it compels the bank to invest in government securities like bonds, because see, there is a limit to which the banks can maintain cash with themselves. After a certain point of time or certain limit, they prefer to buy or keep government securities in the SLR quota. So by this they are bound to subscribe the government securities, because that is only allowed under statutory liquidity ratios, and no other securities are acceptable by the RBI. So these are the advantages of maintaining SLR. Next is the differences between the two. So the first one is, it is the percentage of money which the bank has to keep with central bank. Now that is the first difference, and SLR has to be maintained with the bank itself in the form of cash, gold or government securities. effect, it controls the excess money flow in the economy, and the same purpose SLR also serves, and also helps in maintaining the unexpected demand of any depositor by selling the bonds. Next is, it is maintained with RBI, it is been maintained with bank itself. One of the other major differences that on CRR, commercial bank does not get any interest as a return for maintaining it, but in case of SLR they do get an interest rate for maintaining it, as the money when spent in government securities fetch them a rate of interest. Next is, it is regulates liquidity and it regulates the credit growth in the economy. And the last point of difference is, it is mentioned under RBI Act 1934 and it is mentioned under Banking Regulation Act. So these are the major differences, and you have to be really crystal clear, just not clear but crystal clear with these two concepts, as if you are clear with these two concepts, this will enable you to understand the further concepts in the economy videos, and you would be able to solve the questions with higher difficulty level also. So friends, I wind up my video with this topic only, and thank you so much for your patience listening.